let's go to insurance. And I gave you a hint on that when I showed you my bike riding path from last year. Okay, yes, I can ride 42 kilometers. I usually ride longer, but I was a bit tired that day. All right, can we use data to better price risk? In other words, can we use data to enhance the prediction of the probability of a bad event and the magnitude of a loss? Well, let's have a look. So now we're at the top yellow part, that second section, insurance. That's all we're trying to do here. Can we use data to better predict the likelihood of an event and the magnitude of a loss? Two things. That's all we're trying to predict here. Okay, the big area in insurance at the moment is telematics and insurance. The B2B space is where things are really happening. For example, trucks already today have trackers on them. They can track trucks, whether they are driven hard, soft, and whatever. They can actually track whether a truck is actually within the bounds of what is an insurable, manageable risk. Cars in the same way. You can have a car insurance, and telematics can actually predict your driving behavior based on gauging the behavior of the car. They don't need to look at whether you get a speeding ticket or not. A speeding ticket cannot predict your ability to be a safe driver or not. So, number one, telematics, they fit a clever little device into your car, and that device measures how well you drive. Next, good drivers save money on car insurance. Why? Because cha-ching, you're a good driver. We're going to give you a discount of 10% on your premium when you renew, not just because you didn't make a claim, but also we notice from your car behavior, you are a good driver. Wow, yay! Okay, now someone's a bad driver, maybe they didn't have an accident, but they come close, and that's the telematics is picking that up. They may not get the discount at the end of the year, even though they do not have a claim. Okay, so this is already happening in the insurance space, and early on, you're talking about 5 years ago and longer, they'd had to put a special device in your car. But these days, that device, all you need is something like this. That is a smartphone. And insurance companies are experimenting with, okay, you sign up for our insurance, you've got to use our app, and that app needs to be location specific, and that location must be turned on, and then that insurance company can actually track your driving behavior by tracking your smartphone. Can they do that? Yes, they can. Watch out for that. Wow. So telematics and insurance is another area where fintech startups are coming in and taking away profits and services from the traditional banks. Okay. So remember, telematics, it's about generating data using sensor technology, using smartphones, using GPS trackers. Then it's data collection and aggregation, and then data analysis, and then driver evaluation. Okay. So let's have a look at health insurance, which is a sort of a sister of general insurance, which is focusing on house risk, car risk, vehicle risk, things like that. Health insurance is actually your health, and insurers ultimately would like to have your blood, you know. Oh, there you go, that little blood there, see that? Yeah, all right, they'd like to have your blood. Why? Because then they can test it, and they can test to see is there anything in there that signifies but your likelihood that you will need to go to a hospital and have medical attention for a major treatment, which would actually cost the health insurance company lots and lots of money. That means you become a loss patient, you become a loss customer. All right, so they cannot get your blood. That's something you may say, no, I don't want that. And maybe they say, well, we don't want to insure you. But then you're not going to get many people given blood and insuring. So what can they do as a second best option? Well, they can track your exercise. They could track your eating habits over and above your age, your gender, or other things. It's all about adding columns to the prediction model. Remember in section 1, it's all about, okay, we get more and more customers, that's rows, but adding columns, that is, we add on big 5 personality, we add on demographics, we add on location data. Now we're starting to add on other things like a Fitbit tracker. Now we start to add on other things like other dietary trackers that you type in whenever you buy something, some fruit and veggies from the supermarket, and you buy it through an app, and then they know that you're buying fruit and veggies. You just need to know that if you want to buy bad food, you just have to use cash, and then you can avoid this sensor technology. But that's a side issue. Fintech companies are screaming into this space to try and get more information, that is, adding more columns of data for their algorithms to make better predictions about, are you a insurable risk for health? Okay, and insurers, they will then adjust premiums for going to the gym, buying healthy food and things like that. Okay, maybe you go to the gym, you check in, you check out, but whether you actually do something in the gym, that's another matter. But at least by requiring you to have this behavior, the insurers are now creating healthy habits, so getting you to the starting point. It's for you to actually take the action afterwards. This is a big area of fintech space. Now remember, they're just trying to use technology to get more data on your behavior, which is associated with the likelihood that you will need to have a medical procedure or not. And that's the big idea under health insurance. Even some insurers, fintech startups, that come along and tried to get data from Facebook, and Facebook blocked one of the insurers' discount plan because it was associated with the need for the insured people to actually divulge their information on Facebook. Telematics data provides clear segmentation of risk, and this is what we're trying to do. We're trying to separate the risky client from the low-risk client, the risky driver from the low-risk driver. That's all we're trying to do. And if we can get more data, that means more columns, okay, then we can make a more accurate decision about whether I should insure you or not. And at the same time, better price that insurance. Wow, that's amazing what we're doing. And then there's your Fitbit, so watch out. Now insurance companies are saying that, well, you know, you insure with us, you need to wear this Fitbit, and then we need to get access to your data. And if you do all of this exercise, 10,000 steps a day, 10 floors of stepping, this and that, then we will give you a discount on your insurance. Now, of course, some people will take their Fitbit to the park, and what? They'll put the Fitbit on their dog, and then the dog can run around and they can be in the park just sitting around and reading a book instead. Hey, people do that. So you've got to be careful about these startups. They're coming in, they're trying to get more data on customers by using your smartphone, using these Fitbit devices. It's the closest thing to getting your blood. Remember, it's very hard to get you to consent to give blood to an insurance company. And then if you behave in the right way that shows that you are a low risk, then they will give you a discount. So insurers, they are trialing now connected pill boxes to ensure that you take pills as prescribed. What do we mean by that? It means that when you open a pill box, then it actually shows up on the app that you have opened a pill box. Whether you have taken a pill or not, that is a different story, okay? But at least, remember, the smartphone, the Fitbit, it gets you to the starting line, then you have to show the behavior. At least they're trying to segment those that get to the starting line from those that would not even get to the starting line at all. The smartphone and all these devices can help us with that. And it's all about better pricing the risk of anyone that steps in the door to get insurance. Wow, what's the ultimate? Well, maybe I don't trust you to take the pills, so I'll put a sensor on your stomach. So when the pill goes through the stomach, then the sensor detects that pill and then sends a message back to the insurer to know that you are taking the pill. Can this be done? Yes, it can today. Are there startups in this space? Yes, there are wannabe startups in this space. Wow, I'm amazed. This is science fiction, but it's here today with us today. All right, so that takes us to the end of our first section. Remember, I got 3 sections to go here in this first week. In this first section, let me just recap about what we're talking about. With loans and lending, it's all about tracking and scoring. That is, tracking, getting more and more columns of data about customers, so then you can better segregate them between what is a good risk and a bad risk with their ability to pay back a loan. And so then you use a machine algorithms to better score customers that apply for credit cards, that apply for car loans, house loans, property loans, business loans. Now when it comes to insurance, it's all about using data, using big data to better predict the likelihood of an insurable event and the magnitude of the loss. And so insurance companies are experimenting with using your smartphone to gauge how safe a driver you are. Insurance companies in the health sector are experimenting with Fitbits to gauge what is your healthy behavior like. And then in the process, they are offering discounts. So this is the 2 types of business models that are going on in the lending and insurance space at the moment. So thank you for digesting this. I'm going to come back and we're going to look at the next 2 parts of the World Economic Forum framework. Thank you. This is Neil, and I'll catch you in part 2. Bye for now.